Welcome to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, here's this week's market wrap with commentary and analysis from the low-cost precious metals dealer voted best in the U.S., Money Metals Exchange.
Happy New Year and welcome to this week's Market Wrap podcast. I'm Mike Gleason. In this first trading week of 2021, a new investment theme appears to be emerging, and that theme can be summed up in a single word: reflation. A resurgence of inflation is being priced into asset classes across the board. Stocks are rallying to new records. Shares of Tesla and alternative energy companies are going to the moon. Marijuana stocks are suddenly back in vogue. Bitcoin is going bonkers. Crude oil, copper, and other commodities also started to break out this week, but metals markets pulled back sharply this morning on the heels of a bad jobs report, meaning these markets require more time to work their way back up to last year's highs. For the week, gold is now down 1.9% to bring spot prices to $1,867 per ounce. The silver market shows a weekly loss of 2.3% to trade at $25.93 an ounce. President-elect Joe Biden is vowing to make good on President Donald Trump's promise of $2,000 stimulus checks to most Americans. Biden also intends to push a $4 trillion Build Back Better agenda centered on green infrastructure programs. Senate Republicans will have less leverage to block Biden's spending ambitions. On Tuesday, Democrats picked up 2 Senate seats in Georgia to deny Republicans a majority in the upper chamber. The prospect of a Democrat-controlled government is being greeted with surprising enthusiasm by investors. The prevailing thinking seems to be that more government spending and more cash injections into the economy mean higher asset prices. But the bond market is starting to warn of potential risks looming. Bond yields broke higher this week. The 10-year Treasury yield climbed above 1%, while the 30-year long bond exceeded 1.8%. These yields are still quite low, historically speaking. The problem is that even relatively mild increases in current rates cause bonds previously issued at lower rates to lose value. Not only do those bonds not pay enough in interest to keep pace with inflation, but holders of them also stand to suffer capital losses to boot. The Federal Reserve now faces a conundrum. It wants to keep interest rates suppressed across the yield curve. At the same time, it also wants to raise inflation rates. Inflation is ultimately a destructive force for holders of cash and fixed income instruments. At the same time, inflation can be a boon to bond issuers and other debtors, gradually bailing them out by enabling to pay back what they owe with steadily cheaper dollars over time. The U.S. government is the world's biggest debtor, so it's no surprise that there is a bipartisan consensus in Washington in support of the Federal Reserve's inflationary policies. The Fed is the largest single holder of government bonds. Its unlimited appetite for treasuries has helped keep a lid on long-term yields, even though it doesn't directly determine them like it does the Fed funds rate. With the federal government set to undertake trillions more in borrowing in 2021, the central bank will have its hands full. The Fed wants to have its cake and eat it too, propping up the bond market while enacting policies that erode bond values. Higher inflation and artificially low interest rates are not a stable combination. Eventually, something has to give. Manipulating the gigantic bond market means thwarting free market pricing of inflation risk. But even if the authorities are successful in a particular interest rate rigging mission, the realities of inflation risk will simply get reflected elsewhere, whether in stocks, commodities, precious metals, or cryptocurrencies. Some asset classes may respond to inflation more immediately, others may respond more dramatically over time. Typically, the quote-unquote good effects of inflation are felt first, lifting financial markets. Then the painful side effects of price increases hit the economy. This isn't so good for consumers or most businesses. Then, when wider public concern over inflation risk sets in, financial assets tend to lose favor versus hard assets. The ultimate safe havens of gold and silver tend to assume a leadership role in the inflationary melt-up, and in the late stages, they can go parabolic. It appears as though some sectors of the stock market, along with speculative assets such as Bitcoin, are now entering blow-off phases. Perhaps they'll continue to go up for a while longer. Even if more upside remains, these inflation-driven run-ups could ultimately end badly for buyers who chase them up at current sky-high prices. Meanwhile, the bull market in hard assets may just be warming up. Before concluding this week's Market Wrap podcast, I want to tell you about an innovative new product available through Money Metals, foldable gold you can carry in your wallet. The new American-made gold backs available at moneymetals.com could come in handy in any number of bad scenarios. It's the world's first spendable, interchangeable, small denomination physical gold bullion. Each individual gold back contains actual gold embedded in a beautiful bill-sized form. It's true sound money. Like gold and silver coins, bars, and rounds, holding a portion of your cash in gold backs can offer you a measure of safety and security against inflation and dollar destruction, the preferred tools of politicians who find printing money far more lucrative and easier to get away with than formerly raising taxes. To be clear, though, holding gold backs is an inefficient way to get gold price exposure or to accumulate large amounts of bullion. Instead, the gold back represents a tangible, hold-in-your-hands means of engaging in small transactions with others, making payments that, in and of themselves, represent real value. The gold back cannot be devalued by politicians or the Federal Reserve. In fact, their utterly predictable, dollar-destroying actions are only likely to increase the value of every gold back you own. Money Metals now offers a complete selection of these stunningly beautiful privately issued bullion units in the full range of denominations made. The math is simple. 1,000 gold backs, no matter what combination of gold back sizes you are using, contain exactly 1 ounce of 0.9999 gold. Please act quickly if you want to pick up some gold backs for yourself or others. High demand and limited supplies require us to place strict limits on order sizes. It's important we emphasize that the premiums over the spot price are substantially higher than those you'll find on bullion coins, bars, and rounds, which means the gold back is not an efficient way to accumulate large amounts of gold, but it has a role to play in your overall mix of gold and silver. To get more details or place an order, visit moneymetals.com or call 1-800-800-1865. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.